Hello, everybody. This is Toni Turner, and welcome to the market now as of Friday, February 26th at about 11 a.m. Eastern. Well, Wall Street's main indexes extended losses so far today as fears of a potential rise in inflation has kept U.S. bond yields around a one-year high. Please do know that when bond yields start to rise and start climbing dramatically, the stock market usually falls. And on that slightly less than cheerful note, let's go on to three charts that may give us some insight into the week to come. First of all, as we always do, we're going to look at a daily chart of the S&P 500 SPDR, symbol SPY. Of course, this is the exchange-traded fund that closely follows our benchmark S&P 500 index. Now we can see here the SPY for most part has been climbing in a really nice high, making new all-time highs quite a bit lately. And the SPY indeed made a new all-time closing high, and we use closing highs for all-time highs usually. It made a new all-time closing high on February 12th at $392.64. It kind of jumped up the next day, then started down, falling pretty dramatically here, especially this week. You can see the bulls and bears are duking it out with wide range days. Now, when I captured this chart today, the SPY was trading at $382.46, which is about $38.24 on the S&P 500 index. You can see it is down here now below the 20-day moving average, the red line, and just sitting atop the 50-day moving average, which is coming in here at 379.83. Now, the 50-day moving average is used a lot by institutional traders, so we do want to keep an eye on this, in my case on this chart, the 50-day line, because institutional traders will watch it, and those are the guys, of course, who trade big share size. And we want to see if the SPY can stay above this 50-day moving average, because when it can be above that, when it's trading above it in an uptrend, making higher lows and higher highs, we know that it's as healthy as it can be. Also down here, of course, quite a long ways away, we have the 200-day moving average. We still have potential support here at the past October highs. We can draw a line like that, come in at about 354. Again, 200-day moving average down here at 344. Let's hope we don't have to worry about that anytime soon. If we look down here at the RSI, 14-day RSI, we'll see that it has moved off that overbought line and is now headed a little bit lower. That makes sense, and so is the MACD. So what you want to do here is keep an eye here on the number 379 or 380 for the SPY. Please know that if it falls below that line, really start getting very, very careful. Please trade wisely, and especially if interest rates keep rising next week, please make sure your protective stops are in place. Our next chart today, as we usually do, is a chart of the Invesco QQQ, symbol QQQ. Of course, this is a major index in the stock market, follows the NASDAQ 100. Top holdings, of course, include Apple, Amazon, Alphabet, Google, Facebook, Alphabet and Facebook. The QQQ has been fallen a little more dramatically here than even the SPY. As you can see at the moment, when I captured this chart, the QQQ was trading at $315.55. Now it has fallen below certainly the 20-day line and the 50-day line. So it's kind of in a precarious position here. Of course, a lot of these big high momentum tech stocks had become very overbought, had gone up dramatically. Of course, there are those that say that parts of it were in a bubble. I can't disagree with a little bit of that. Anyway, again, when I captured this chart today, the QQQ was trading at $315.55. Now, it made a new all-time closing high on February 12th at $336.45. that is when it kind of jumped up like the SPY did and then started falling pretty dramatically. And especially in this past week as we saw bond yields start to rise. Now price resistance here still remains at 335. Support remains here from the October and November highs. We can draw that line. I didn't draw it too straight, but it comes in at 299, 298, 299. Of course, then we have the 200-day moving average down here offering potential support at $282.32. Now, we have these lows here from the past 4 days. If you look right here with me, these lows come in at just about 313 actually on the QQQ. So I'm going to keep an eye on that 313 potential support line here. Please watch it too. And if the Qs cannot stay above 313 and start to tumble lower, if bond yields continue to rise, please, please, please keep your stops in place. And remember something, people, cash is a position. Being on the sidelines is not always a bad thing, especially if the market is volatile and headed out in all directions. Okay, and look at the volume down here. Some of this selling was done on high volume. So just please remember, cash is a position, and sometimes the sidelines is a very nice place to be, and it's certainly valid. Okay, let's go on to our final chart here. Our final chart today is the Invesco DB Base Metals Fund, symbol DBB. Now, I am going to tell you today there was not a heck of a lot to look at as far as long setups go on ETFs. Most everything was headed down. However, I did look at this DBB fund, again, Invesco Base Metals Fund. Now, this is a commodities fund. This fund is composed of futures contracts in some of the most widely used base metals, aluminum, widely used base metals, and that includes aluminum, zinc, and grade A copper. So you can see here, first of all, let me say this. Please know that the DBB is considered a commodities trade by the IRS. So you or your accountant is going to need to know how to treat your profits or losses. It's a very positive tax method for you, but you do need to know how to manage it. Otherwise, you could make this trade in a tax-advantaged fund account like an IRA, where that wouldn't really matter. So let's go back to the DBB. This fund started, actually, it's fairly new. It started in December of 2007. You can't see that on this chart, of course. It flew to a high of 34 and then fell to a low. Of course, we had the recession in 2007, 2008, and it fell down to about 11. And again, you can't see that on your chart. Then started higher. Now we can see how even since June of last year, we can see how the DBB, look left on the chart with me, has pretty much walked up its 20-day line into September, then fell a little bit lower, then started moving up, fell down to what, about 1450, then jumped back up over the 20 and 50-day moving average and moved in a very nice uptrend, actually at a premium to or higher than and not touching its 20-day line. Okay, gently fell back again, very nice uptrend. Fell back down again, down to the lows here in the February low back here at $16.75. Then it moved back up quickly from those lows, moved up quickly back through the 20-day, back through the 50-day, and back up to a relative high this past Thursday right here at $19.60. You can see it gapped up on Thursday and then fell pretty dramatically and is down, but most things have been back down here to today's price. And when I captured this chart, it was trading at $18.85. Now, It has been in an uptrend for some time that we can see. We can connect these lows. And when you see these really dramatic moves higher as compared to past moves higher, when you see an almost parabolic move like this, if you can catch it as a trader down toward the lows of this move, or maybe even get a signal when it moves up over the 50-day moving average, that's good. But when you see it rise to a high, then gap up like it did on Thursday, that's called an exhaustion gap higher. And then note that the RSI is overbought. It's trading over this 70 line. So this is not a good place to get in long for a short-term trade. Not a good place. This is where you wait. This is where you wait. So I think the DBB may more have room to go, but I'm also going to sit it out. So I'm not going to buy now, but I'm going to wait for it in the coming week. I'm going to look for the DBB to retrace lower, maybe to 1850, 40, 30 would be nice. Even down to 18 would work for me. As long as it can stay above the 50-day moving average, but hopefully get a little closer to it. When it's down here, I expect this may take 3 or 4 more days. Now, if it comes down and plunges through the 50-day moving average, obviously I'm not going to buy it. But if it stays above that and then starts to rally, so I want this kind of move, that's the high we're seeing. Now it pulls back and then goes like that. If it does that, then, like I said, around 18 or 1850 is okay. Then I might buy a small share for my trading portfolio. As long as it stays above the 50-day moving average, I am going to put my initial stop down here at $17.60. I'm going to put a tight stop on it just below the 50-day average at $17.60. Now, this will take time, but if it does, if I get in here, around here, and it does manage to rise back up again, if it moves up and above resistance, I'm going to call it 20 here and closes above it. By then, it should have shaken off some of the sellers here. I may add to my position. Of course, by then, my stop will be a trailing stop. So you may want to keep an eye on the DBB in the coming week. And now, before we go on to final thoughts, please know that if you'd like to become a more successful trader, this is a great time to check out my trader training programs. You're going to love my powerful strategies devoted to swing trading, trend trading, bottom fishing, and more. My programs are easy to understand, and they can help you increase your gains quickly and easily. To see all of my online training programs, simply go to the link on this screen or just click on the orange button below. And now, on to final thoughts. Our question today is, how can I keep my emotions from swaying my mind in one direction when my rational mind is telling me to take different actions? We all know by now that when we are trading, the one true enemy lurking in the corner is our emotions. Greed will urge us to chase a trade, or greed will urge us to stay in a position too long. Fear and downright panic can cause us to jump out of trades too soon. Either of those situations, ruled by our emotions, can result in disaster. So whenever you realize, and I've done this myself, whenever you realize your mind is having a battle of emotions versus rational thoughts, it's time to make a list that separates the emotional side of your internal argument from the rational side. Now, if you're in the middle of a trade when you realize that this mental combat is going on, first, take steps to protect your capital. Perhaps you close out the trade or at least enter a hard stop with your broker. Next, please this just takes 2 minutes, guys. Take a couple of minutes to complete this next step. Draw a straight line down the middle of a page. Take a blank piece of paper and draw a straight line down the middle. You're going to end up with 2 columns. At the top of the left column, write down emotions. Then below that heading, jot down the actions that your emotions are telling you to take. They're telling me, eek, you got to get out, or you got to do this, you got to do that. But most of the time, those emotions are not giving you good decisions. Then at the top of the right column, write rational reasoning. Beneath that heading, write down what your rational mind is instructing you to do. When your lists are complete, ask yourself 2 questions. Where are your emotions clouding your rational thinking? Rational thinking is defined here as numbers and patterns on your trade's price chart. And 2, is there a chance at all that your emotions hold any validity at this moment in time? Do your emotions hold any validity at this moment in time? Probably not. So the next time you find yourself holding an internal battle between emotions and rational reasoning, take time out to separate and identify your thoughts. Once you make your list, it will be much easier to see which side should rule your actions related to your trades. And of course, the rational reasoning side will almost always win the match. Finally, if you'd like to become a more successful trader, check out my trader training programs. To see all of my online trading programs, simply go to the link on this screen or click on the orange button below. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.